Welcome to Vested Interest. This is Shane, and before we get into the video, I'd like to take a moment to thank everyone who's taken the time to watch, comment, and like the videos, and a special thank you to those who subscribe to the channel. I really do appreciate it. And Merry Christmas to those of you out there tuning in today. Really do appreciate it. Hope you had a very Merry Christmas. Hope you have a very Happy New Year, and I do hope that 2023 was a great year for you overall. I have been talking about tax loss harvesting on the channel. So I thought I'd do a quick video here while my wife is taking a nap on New Year's Day so that we could cover this. If you have not taken the time to hit that subscribe button down below, hit the subscribe button and join us here in the Vested Interest community. Join this journey to passive income and financial freedom. That is what this channel is all about. We are dividend growth investors here, or I am a dividend growth investor. Hopefully that you are as well. That's why you tuned into the channel. Hit that notification bell so you're notified anytime we post any new content. And drop a comment below. Let me know what you think of the video. What have you been buying this week? What did you get for Christmas? What did Santa put in your stocking or under your tree? Let me know in the comment section below. Again, hit that notification bell, and most importantly, subscribe to the channel. So let's jump right in. We are going to talk about tax loss harvesting on this one. And what is tax loss harvesting? Tax loss harvesting is the timely selling of securities at a loss to offset the amount of capital gains tax owed from selling profitable assets. This strategy is commonly used to limit short-term capital gains, commonly taxed at a higher rate than long-term capital gains, to preserve the value of the investor's portfolio while reducing taxes. So what does that mean? Basically, if you have capital gains this year, you've made money maybe selling some stocks that were profitable, or you've made money in dividends. Again, I'm a dividend growth investor, so I make money on dividends. And it looks like you're going to owe some taxes, and you have some positions that are in the negative that you are taking a loss or could potentially sell and take a loss on. It's a way to sell those assets and offset some of the gains. So key takeaways: tax loss harvesting is a strategy investors can use to reduce capital gains taxes owed from selling profitable investments. Capital gains are the taxes that you have to pay on any money that you make whenever a stock goes up in value and you sell it to take those profits. Well, that's a capital gain. If you get dividends, that's a capital gain as well, right? So again, tax loss harvesting is a strategy investors can use to reduce capital gains taxes owed from selling profitable investments. So on those gains that you might have, either from dividends or selling stocks, you could sell some of the other companies you may own that are at a loss to offset what you owe in those taxes. A tax loss harvesting strategy involves selling an asset, right, or security at a net loss. So it's on stocks that have a loss. You can use proceeds from a sale to purchase a similar asset and maintain the portfolio balance. We'll talk about this a little bit more in the next couple slides, but you have a time frame where if you sell, I sold Bank of America recently, so let's use that as an example. When I sold Bank of America, the time starts ticking, the clock starts ticking. I cannot buy Bank of America again within 30 days. So I have to wait at least 30 days. I really wait about 31 to 35 days to make sure I am in that window. Otherwise, you'll ruin what they call the wash sale. We'll see that in a minute. But you can buy similar assets. Let's say I sell Bank of America, for example, which I did, and I want to buy another bank. I can buy another bank, U.S. Bank, Ally Bank. I can buy shares of that company, and it won't impact my sale of Bank of America. I just can't buy Bank of America shares again within 30 days if I plan to use that as a tax loss harvesting strategy. How tax loss harvesting works. Tax loss harvesting is also known as tax loss selling. Most investors use this strategy at the end of the year when they assess the annual performance of their portfolios and its impact on their taxes. An investment that shows a loss in value can be sold to claim a credit against the profits that were realized in other assets. So that's a good way to look at it, right? I'm going to take something that I'm down in at a loss and sell it at a loss to offset the other positions in my portfolio that I might have sold at a gain, or to offset the dividends I've received out over the year. Tax loss harvesting is the tool for reducing overall taxes, and that's really the bottom line. That's really what you're trying to do here. I want to pay as little as taxes as possible, so this is a way to legally reduce my taxable obligations. A loss in the value of security A could be sold to offset the increase in the price of security B, thus eliminating the capital gains tax liability of security B. Using the tax loss harvesting strategy, investors can realize significant tax savings. And that's, again, what it's all about, trying to limit the amount of taxes we pay at the end of the year. Tip: if your capital losses for the year exceed your capital gains, you can deduct up to $3,000 in net losses from your total annual income. If your net losses exceed $3,000, the Internal Revenue Service, the IRS, rules allow the additional losses to be carried forward into the following tax years. So what does this mean? This basically is saying, okay, if I've lost more than I've gained, maybe you're a newer investor and you have some positions that are significantly down and you don't have a lot of positions that were in the green that you sold and would have had gains to pay capital gains on, or you don't have enough in dividends to really claim anything. You can say, okay, I've lost $3,000 this year in that I'm going to harvest, my tax loss harvesting, and I've lost $3,000, but I've only gained $1,500. So that $1,500 difference can be used to decrease the amount of income, right, from your regular day job that you made. So if you made $40,000, you could take $1,500 off that $40,000, and that would reduce. You don't want to be paying taxes on $38,500 at that point. That's what they're saying here, and it's only up to $3,000. But let's say you had 10,000, using round numbers for examples. Let's say you had 10,000 in losses, and the 3,000, right? You offset whatever gains you had. You had 3,000 left, and let's say you had another 3,000 out of that 10,000 left. You could roll that into next year, so you could write that off into next year's taxes as well. So it's not just about this year's taxes. If you have enough in capital losses to offset your capital gains, plus reduced by the 3,000 for the year, anything extra you could claim on next year's taxes. Important: losses on your investments are first used to offset capital gains of the same type, right? So there's first. It's going to offset whatever capital gains. So if you have capital gains on an asset that you've sold at a gain, you can then sell a stock and offset the capital gains that way. Therefore, short-term losses are first used to offset short-term capital gains taxes. So that's where you own an asset under a year. That's going to be short-term capital gains or short-term losses. Whereas if you have a stock over a year, it usually hits the long-term, and then that's a different tax rate, right? Usually it's 15% for anything that's qualified dividends. Anything under that is going to be based on whatever, anything under a year is going to be based on whatever your income tax bracket is. Therefore, short-term losses are first used to offset short-term capital gains tax, and long-term losses are first used to offset long-term capital gains. But net losses of either type can be deducted against the other kind of gain. The wash sale rule. This is what I was talking about earlier. Whenever you sell an asset, you can't go back in and buy that same asset. Like, I can't sell Bank of America and then turn right around within 30 days and buy back Bank of America. It would be a wash. They would say, oh, okay, you bought it back, so you didn't want to use this tax loss harvesting strategy. The wash sale rule requires that investors avoid buying the same stock sold at a loss for tax purposes. A wash sale involves the sale of one security, and within 30 days, there's that time frame, within 30 days, purchasing a substantially identical stock or security. If a transaction is considered a wash sale, it cannot be used to offset capital gains. And if wash sale rules are abused, regulators can impose fines or restrict the individual's trading. Using ETFs that track the same or similar indexes can be used to replace one another while violating the wash sale rule in a tax loss harvesting strategy. If you sell one S&P 500 index ETF at a loss, you can buy a different S&P 500 index ETF to harvest the capital loss. So that's what I mean. If you sold VU, for example, you couldn't go right back in and buy VU within 30 days. If you sold Bank of America, you couldn't go right back in and buy Bank of America within 30 days. But you could buy a similar security. Like I said, you could sell Bank of America and you could buy US Bank or Ally Bank or another bank stock. Or you could sell VU, and then you could turn around, and that's what they're saying here. VU is a S&P 500 ETF. You could sell VU, and then you could buy a different S&P 500 index ETF, like the SPY, something like that. Example of tax loss harvesting. Assume a single investor earns an income of $580,000 in 2023. Replace any number you need to here, right? Assume you made $58,000. Assume you made $40,000, whatever it is. The investor's marginal income tax rate is 30%, 37%. Assume whatever your income rate is. Plug in your income rate here, 15%, 20%, 23%. I think mine is in the 30s. I don't know if I'm 37%, but I'm pretty doggone close to the highest tax bracket. That's just my wife and I are high earners. That's just the way it is. And is subject to the highest long-term capital gains tax category. Where gains are taxed at 20%, short-term capital gains are taxed at the investor's marginal rate. Below are the investor's portfolio gains and losses and trading activity for the year. So here's your portfolio. Mutual fund A, 250,000 unrealized gain held for 450 days. So that's over a year, over 365 days. Mutual fund B, 130,000 unrealized held for 635 days. That's over the 365 days. So both of these first two, fund A and fund B, are both held for over a year. Mutual fund C, 100,000 unrealized lost, held for 125. This is where short-term gains or losses would impact. Long-term for the first two, short-term for the second one. Trading activity. Mutual fund E sold realized gain of 200,000. Fund was held for 380 days. So that 380 days is over 365. So that's going to be qualified gains right here. That's going to be a different tax bracket. Mutual fund sold, realized a gain of 150,000. Fund was held for 150 days. This is under the 365 days, so that would be short term. The tax owed from these sale is tax withholding harvesting equals 200,000 times 20%, right? There's that 200,000 times 20% because it's over 365 days, so that's the 20%. 150,000, since it was held under 365 days, that's going to be short-term capital gains. So that was at 37%. So whatever your tax bracket is, the short-term gains would be the 37% or 20%, whatever your tax bracket is, equals 40,000, right? So 200,000 times 20% plus 150,000 times 37%, whatever that tax is, that's 40,000 plus 55,500 equals 95,500. If the investor harvested losses by selling mutual fund B, that's this one, and C, that's this one, the sales would help to offset the gains and the tax owed would be tax with harvesting. There's 200,000 minus 130,000 times 20,000, 150,000 minus 100,000 times 37 equals 14,000 plus 18,500 equals 32,500. So that would be the amount harvested. The bottom line, tax loss harvesting is the timely selling of securities at a loss to offset the amount of capital gains tax owed from selling profitable assets. An individual taxpayer can write off up to $3,000 in net losses annually. For more advice, and this is the important part, for more advice on how to maximize your tax breaks, consider consulting a professional tax advisor. And this is where I pulled that information from. You go to Investopedia.com, type in tax loss harvesting, definition and example. It will give you that and a little bit more information than I did. And you can go ahead and scroll through that and go through it as slowly as you need to understand this. And really what you should do is this. For more advice on how to maximize your tax breaks, consider consulting a professional tax advisor. If you are to the point where you have enough extra income, you've paid down your debts, you're investing, you have a nice stock portfolio, you're starting to get dividends, you're starting to buy and sell shares, you're getting gains or you have losses, now is the time to really go out and find you a tax advisor that you trust that will do your taxes and help you with the questions like this one. How do I offset my taxes? How can I use tax loss harvesting to offset my taxes? What do I need to sell? What can I buy? When can I buy? When can I sell? Tax loss harvesting has to be done by the end of the year. So we have a week left in the year where you could utilize this strategy. That's why I'm doing this video before the end of December and taking the time to do it on Christmas Day. Again, Merry Christmas to you out there. It is important. It is a way to offset taxes, but you have to understand what you're doing. Really, the simplest way to put it is if you have gains, you've sold some stocks at a profit, and you have some gains, whether they're short-term gains or long-term gains, you could sell some other stocks at a loss, not buy those shares back for 30 days, and then take the short-term loss or short-term or long-term loss and offset those short-term or long-term gains. It's a way to offset whatever gains you've made for the year by selling an asset at a loss. That's really what it boils down to. I hope that was beneficial. I hope that made sense. I had been talking about it. I did do some tax loss harvesting in my portfolio this year. Like I said, I sold some Bank of America shares recently. I'm past the 30-day window, so I will be looking for an opportune time to jump back in there. I've been running the wheel on those. That's part of the reason I've run wheels on some of my position. SBSW is another one that I recently ran the wheel on. It was called away, so I'm going to use that as a way to offset some of my tax liability for the year. I won't be buying back into SBSU or SBSW, Siboney-Stillwater, within the next 30 days. I think it's January 20th. Sometime after that, I can look to jump back into Siboney-Stillwater. But I'll probably run the wheel on it in the meantime. Well, I hope that made sense. Again, jump over to Investopedia and check that out. Investopedia.com, tax loss harvesting. Go ahead and plug that in your computer. You can run through their examples. Plug it into your computer, into your search bar, tax loss harvesting. There are other sources and sites that will cover this as well, but I just wanted to cover it on the channel because it is something that I've been talking about recently. As always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that thumbs up, ring the notification bell. Most importantly, subscribe to the channel. Hit that subscribe button down below. Join us on this journey to financial freedom. Join the vested interest community, building a community of like-minded dividend growth investors so we can share information like this, tax loss harvesting, what we're buying, what we're selling, stocks to avoid, stocks to watch. I do a stock pick of the day series Monday through Thursday, so tune back in for that. And I do personally read and respond to the comments. I'm always interested to read your questions, opinions, or suggestions for future topics. So if you have a stock you'd like me to cover in the stock pick of the day series, go ahead and drop it down below. And this is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, Merry Christmas. Thanks for stopping by. We'll see you in the next one. I'm not a financial advisor. Nothing in this presentation should be considered financial advice. I'm only sharing my opinion. Investing in for educational and entertainment purposes. Investing involves risk and change money. You should never invest any amount not comfortable losing. Always do your own research. Invest based on your situation, circumstances, and select criteria. Or seek the advice of a certified financial advisor.